All right, Rob, it's been sort of it's been a wacky week in markets. It's been a wacky week in geopolitics. It's a wacky week in general. It's I guess the dog days of summer. People are reacting that way. I thought we would start, at the beginning of the. If we had recorded this podcast at the beginning of the week, we probably would have spent the entire time just on market wackiness. I have a feeling we're not going to spend the entire time on market wackiness because things have calmed down quite a bit. But to start the week, Japan stock index went down 12% in one day, and the yen got close to 140. It might have even breached. I don't know if it did, but I remember seeing it around the 140 mark. And financial media just collectively freaked out, metaphorically self-immolated. I mean, people were going, not, this wasn't fringe stuff on social media. Like on Bloomberg, you had respected economists and professors saying they have to have an emergency cut of 75 bips and then another emergency cut of 75 bips. I mean, people just absolutely losing their minds and talking about, is this a recession? Are they going to have to do rate cuts? Things like that. Markets rebounded literally the next day. The Nikkei was up 10% the next day after all this bloodbath, and the U.S. markets are basically back where they were before. What did you make both of the market wackiness itself and also just the insane coverage of it? I know we like to make fun of financial media quite a bit, but it was pretty insane. I guess the one thing going for them was the VIX, which for those of you who are not initiated, is sort of a gauge of not a gauge of relativity, a gauge of volatility in the market. Saw basically the three highest spikes in volatility in the market are the 2008 financial crisis, COVID, and whatever the frack happened this week. So something happened, like it was real. It wasn't like it was a complete and total mirage. But tell us how to make sense of it, Rob.
Yeah, at first I didn't really want to talk about this, and I had people messaging me saying, "Oh my God, what's going on?" And I know they listen to this podcast, so I don't want to make fun of them. But my response was like, "I'm busy right now. Like, leave me. I'm. I don't want to talk about this right now." And they're like, "But isn't this really important?" I said, "No, it's really not." Like I said, if you think we're going into a financial crisis or something, then we're not. So don't worry. But it is important to talk about why this happened. And I don't mean necessarily the specifics, because there's plenty of people who will, you know, enjoy explaining the yen carry trade and all this stuff. We don't really need to get into that. Um, and I don't have anything to add that anyone else can't sort of just lay out for you. But what I would add is sort of putting some context around this. Like, why did this happen? Why is it important? Why are we likely to see more of this kind of thing? Because that's really what matters, is looking forward. How do we anticipate what's going to happen? And I think in that regard, this is a pretty interesting development, not because of what it is, but for what it sort of signals. So, very briefly, what we saw was sort of a forced selling event uh, because of the yen carry trade, because of a lot of sort of stretched traders out there who, without going into all the specifics, were basically engaged in kind of illiquid arbitrage trades. So borrowing from over here to buy over here, that's what the yen carry trade is. And that became very violently unwound when US interest rate expectations were declining at the same time that Japanese interest rate expectations were rising a little bit. And long story short, that kind of blew things out of whack. Now, this is important not because of what I just said, but rather because what it shows is the sort of slippage in the market right now. When you have a lot of levered players and you have sort of markets that lack liquidity. And when I say, what do we learn? How can we anticipate what's going to happen in the future? What does this teach us? I think the key takeaway here is we should expect to see more events like this. I know the people were joking when they compared what the VIX did and said, "Oh, it's 2008 and COVID, and then the Japanese central bank raising interest rates 25 basis points." Like the scale of slippage, the scale of markets just sliding around on kind of just bullshit, forced selling or technical moves that don't have much informational value. That's something we need to start to live with and understand more. Like we're seeing that at the stock specific level. Just to give an example, like this has been going on for the past 4 or 5 years, and you don't see it as much. How do I say? You haven't heard about it as much because people like to talk about indices and currencies and the stuff that everyone's watching. But if you look at individual stocks, I can tell you with certainty, because we're in the weeds on them every day, that they are sliding around and moving around and jumping up and down for reasons that are not informational, for reasons that are purely just noise, much more than they were. So, to take one specific example, there's a company that we've been recommending short at Off Wall Street. It's called Amcor, AMKR, right? Now, this is a stock that uh, in the beginning of July broke out to a new all-time high. It went from $30 to $42 or $44 in 3 weeks, and it had been trading in this range for several years. And without boring the audience who doesn't care about technical analysis, the the punchline is that's a really important signal usually. And historically, any technician, and technician I mean someone who's looking at the behavior of the market itself for information about where things are going, any self-respecting technician would say, oh my goodness, that's a big important breakout. Something important just happened. The market knows something. Someone knows some information. And what happened was it went from 30 to 44, and they reported their earnings, and their earnings were, quite frankly, an effing disaster. And it immediately went back to $28. Um, that I don't know how to relate this in a way that hits in the gut. That is a huge departure from how markets usually work. And that's happening all over the place on the micro level with individual companies and stocks. And now increasingly you're seeing it with, the Japanese yen, which is one of the biggest and most liquid markets in the world, or US Treasuries, which is one of the biggest, probably the biggest market in the world. And that's extraordinary. But what it does mean is as that happens more and more, we I'm preparing as you know, a big thing right now for a prospect on, and one of the key issues we're talking about is the value of liquidity. This shows the value of liquidity, because if you are sitting on a bunch of liquidity and waiting for this opportunity, and all of a sudden the Nikkei is down 12% for some stupid reason, you can have the confidence to step in and buy, because you're taking the opposite side of everyone who is stretched on liquidity and overextended and exposed to this sliding and slippage and that sort of thing. And I think that's the big takeaway here, is it underlines the value of what we've been droning on about for a long time here, which is in a more volatile world, you want to retain more dry powder, because there's going to be more crazy shit happening all the time, and people are going to overreact in a major way, and markets are going to overreact in a major way. And you want to be there to be a bastion of liquidity and sanity when that happens.
Yeah. So maybe it's a second. So Buffett had when people are scared or when there's blood on the streets, you should buy. So the Rob Larity corollary can be when people are drunk, the sober people should buy. I don't know. I think that's what you're talking about. Sober liquidity. Um, maybe that'll be our band name. But so there's two things though in there that I wanted to ask you about, and also I don't think I sent you this. I can't remember which investment bank it was, if it was Chase or Merrill Lynch or wherever else, but it was some report that came out right after the big move in markets, and its key takeaway was that the value of liquidity is rapidly declining. You are losing the opportunity to lock in yield at the current level, so you got to go buy like all these bonds, buy these equities right now because things are terrible. So I mean, it's amazing to me that that's the consensus point of view. But I guess the first thing I wanted to ask you is that makes sense to me. But then why was it that a potential 25 bit move in Japanese interest rates could create this magnitude of a change? Like, are that many people actually tied up in the yen carry trade? Like, it did seem for a quick, like a split second there, like the entire market was completely crashing in on itself. So, like, what teases us into or what explains the size of the move?
Um, I saw some people trying to compare it to the 1987 market crash, and in many ways that's a silly comparison, but it does have some similarities. And particularly to answer your question, why do you get these outsized moves like this? You get outsized moves when people are forced to sell something. And people get forced to sell something because they need to cover a liability for the most part. And that liability could be a financial liability, meaning you literally have, to cover a debt, you need to sell something to pay off something else. Or it could be a self-imposed leverage liability where hey, our risk budget has exceeded this level. We need to sell down to bring our risk budget down. Um, all sorts of these triggers are always built into markets. And what you had in 1987 was because of the issue of portfolio insurance, which was essentially a quantitative automated doohickey that people thought up that basically said, oh, it'll be fine. You just lever up and buy the index, and then if it starts to go down, you sell it. I mean, if I'm way oversimplifying, but that's basically what it was. But what it didn't take into account was, well, if everyone's trying to sell at the same time, there'll be no bid. So everyone's gonna rush for the exits simultaneously, and then you get Black Monday, and the stock market's down 20% in a day. And you know, Stanley Druckenmiller is making hay. Um, so uh, actually, I think Druckenmiller got crushed in 1987. I'm thinking of my man Paul Tudor Jones was the
It's
one who
always
called it.
the answer is always Paul Tudor Jones, I think, when it
Sorry,
comes to.
I'm getting lost down the nerdy trader hero rabbit hole here. Um, where was I? So yeah, it's a similar thing today. Obviously, the mechanisms are different. There is no more portfolio insurance. That's died an ignominious death, but it's a similar setup. And that's what I mean by liquidity is like people's balance sheets get stretched, their risk budgets get stretched, and they're reaching for yield, they're reaching for return by stretching those balance sheets. And this is what happens because then you're forced to sell at a time when you don't want to. And that's what I mean by having your dry powder is you can choose when you buy. You're never forced to sell. That's the
Mm.
benefit of not running with leverage in all of its forms.
That makes sense. But then the second question for the tactician to ask is, and this is, I mean, relevant for us because we've been incredibly optimistic about Japanese markets. So on the day when the Nikkei drops 12%, like, how does that make you feel as someone who is actually managing capital? Or like, it's probably easy to say that right now here on Thursday, August 8th at 7:30 in the morning, but at 7:30 in the morning on Monday, were you like, not a big deal? Were you getting the dry powder and saying, boom, let's go buy a bunch of Japanese equities while they're on sale down here, down 12%? Like, how do you take advantage? Like, aside from having dry powder and things like that, in the actual moment when somebody is calling you up, like, is there a move, or is it literally just, no, this is how the market is going to work now, I'm not going to be scared into making a move in either direction? When I get a weird result like this, I'm going to trust my method and stick with what I've been doing for the last 6 months.
Yeah. Um, this is a case where I think the layman actually has a great advantage over the market professional because market professionals have their head in it every day, and you know the information flow, their perspective gets so narrowed in and curtailed to the very, very short term. So this feels like an enormous thing, and your emotions are high, or all of the things that make it difficult to act in this way. The layman who doesn't, like most of our listeners, I imagine, don't care that much about financial markets. Like I'm sure they own assets and look at them from time to time, but I would guess the average person who listens isn't trading in and out of the market every day. And that's good. Like I still remember in 2008, um, in March of 2008, I got a call from a buddy who was just like, I don't know what he did. He wasn't in financial markets. He was just like a guy, like a high school buddy, kind of like, pick up basketball kind of friend. And he was just like, "Oh yeah, I saw John Deere was trading for $5 a share, and I just bought a buttload of it." Like the guy never was involved in, and it turned out to be great because he just wasn't paying attention. It was like, "Oh, John Deere's on sale for $5 a share. Sure, I'll buy that." And you sort of have to take that mentality. And if you aren't so distant where you can do that very easily, you need to create the mental space for yourself to do that. And that means having appropriate time horizons. Like unless you're managing money in a institutional or professional context, there's no reason why you can't set this up for yourself. um, and you should be watching if something is on the front page of the New York Times. That might be a nice uh, barometer to use. If it's reached that level, you should probably go in and buy something. Otherwise,
Mhm.
just ignore the markets.
Yeah, I use my sister as my best indicator. If I get a call from my sister about something that's happening in the stock market, I know that there might be a really interesting opportunity. And on Monday at about 11 a.m., she doesn't listen to this, so I'm happy throwing her under the bus. And if you do listen to this, Leah, hello, nice for you to be my indicator. Um, Around 11 on Monday, she texted me, "Why are markets doing so badly? Is there anything that I should be buying right now?" And I was like, "Oh shit, I really need to get back to my computer and see if there is anything I should be buying right now if she's asking me those questions." Um,
Oh man, yeah.
any,
My barometer is my wife, Juliet,
mm,
who like she does not care at all about markets or what we do and finds it slightly distasteful and stupid. Um, but like every 8 or 10 months, whenever there's something really bad, she emails me or she'll message me and be like, "Are you okay? Did your business go under today?" I'm like, "No, no, everything is fine." But that's always the bell ringing, like, oh, it's on her radar screen. So now is the time to step in.
I don't know if I've told the story before. I forget the exact sequence of things, but I was in college and I was just getting interested in markets and things like that. And sort of like your college buddy friend, I remember BP stock was super low or something. And I was like, I'm going to buy some BP stock. That seems like a good idea. And I think it was, I can't remember, it was probably before the 2008, or I forget, it was around 2008. So it all sort of jumbles together. Anyway, I bought BP like a month before Deepwater Horizon, and the whole thing just like literally blew up in my face. And so I was at a bar with some friends at our favorite bar, the Chapter House in Ithaca, which has since burned to the ground. Really sad. Pour one out for the Chapter House. And mentioned this, after two beers, like, oh, I like tried my hand at markets and I got burned and blah blah blah. And one of my friends, I won't say his name, but he's actually been on the podcast before. He got up, he looked at me and said, "You invest in the stock market?" Disgusting. He got up and he left the bar. I didn't see him for 2 days, even though he was my roommate. Anyway, so interesting reactions from people. Anything else you want to say about the market wackiness before we get into other things?
Let's talk
Let's
about
get out
other
of here.
stuff. I'm
All
done with
right,
this.
Rob's done. Thank you for dirtying yourself with the stuff that everybody was interested in. So the stuff that people are probably not interested in or not following that closely is that the biggest sort of political vibration of the week came from Southeast Asia, Bangladesh in particular. So I guess she's the erstwhile prime minister now, Sheikh Hasina. She had to flee her own country on Monday after a violent crackdown against a student protest movement. And to watch it evolve, it was actually kind of strange to watch it evolve because it didn't seem like that big of a deal. She has been or had been prime minister of Bangladesh for almost 15 years, and she had been increasingly taking more control of the country. I think it's calling her an autocrat, I think, is a little too much, but I mean, she certainly had authoritarian tendencies and was trying to increase her power. But you have these student protests, which were over a quota system to give half of government jobs to specific groups. And they had been going on for weeks. They had been going on fairly peacefully. But Ms. Hasina got, I guess, tired of them at some point and decided that an aggressive youth wing of her party should attack these protesters. And then she deployed the security forces to go after them after that. So then you had weeks of street protests, and security forces and crowds were starting to clash a little bit. Almost 200 people died in late July as part of the protest. And she ratcheted up again. And about a week ago, I think it was last Sunday, she deployed government forces again, and over 100 people died just in one day. And the reporting suggests that she wanted to stick around. She gathered herself and her sister and all of her confidants and things like that. They are, by the way, these two women, Hasina and her sister, the only members to survive the 1975 coup that killed their father, who was Bangladesh's founding leader. So there's a lot of interesting historical intrigue here that was probably driving them. And she wanted to hit back even harder. She said that what the police had done was something that the other forces should emulate. But the military at this point intervened and said, hey, like, this is not going to continue going this way. There are hundreds of thousands of people pouring into the capital. There's no way we could manage this even if we wanted to. So she has since fled to India. Um, it was reported that maybe she wanted to go to London, but she's been held up in India, and now there's speculation that maybe she's going to come back. Um, a Nobel Peace Prize winning economist who is 84 years old has returned to Bangladesh to lead an interim government. I don't know why we keep on picking people who are in their 80s, but apparently that's the popular thing. When I'm in my 80s, I plan to be like sipping little drinks with little umbrellas in them and not caring about what's going on in the rest of the world. But anyway, 84-year-old comes in and replaces the 76-year-old wannabe autocrat Hasina. Um, I know you dove a little bit into Bangladesh, Rob, because it's a fascinating country. Like once you start reading about Bangladesh, it's actually kind of hard. It's hard to stop. So tell me what your initial thoughts are and why people should care about this, even though they probably don't.
Um, so there's a lot of different threads here. No pun intended. Um,
But
yeah,
be here
that was
every week, folks. Every
that was
week.
pretty good.
Yeah.
Um, the most obvious thing is Bangladesh is a major producer of textiles, and that sounds like something that some high schooler would read from a book report. Um, but that's actually a really big deal because, especially for Europe, Bangladesh is a major exporter of textiles into Europe specifically because Europe has a very specific trade tariff exemption for very poor countries, and Bangladesh is within that group. So, for that reason, most of the clothing that people in Europe uh, wear is made in Bangladesh or it's made in Vietnam. And I was planning to look at the tag on my shirt right now to see, uh, but I can't see my own shirt without taking it off, which I think is
Leave
probably
your
not
shirt on,
appropriate.
please. So we don't want to get flagged as an X-rated podcast or something like that, please.
So, so this is a $60 billion export industry for Bangladesh. They've essentially organized their entire economy, their export economy, around textiles, which is why this is interesting. Um, Something like 90+% of all exports from Bangladesh are textiles, which is, I mean, they're a one industry town, and they've built everything around this. The whole notion is that they build these textile factories along the waterways. And because you have cheap transportation, the infrastructure in the country is otherwise pretty horrible. So you don't have reliable railways, you don't have reliable sort of warehouse facilities inland like you do in China, for instance. So they're really dependent on these waterways, and they're dependent on, once again, a recurring theme on the podcast in recent weeks, subsidized energy costs, specifically subsidized natural gas costs to make energy cheap for these factories. So I said there's a lot of threads here. You have an interesting story about economic development where they've put all their chips on this one industry, and they've used, in many ways, sort of this authoritarian government to create an environment that's very favorable for these textile firms, including by subsidizing their energy. Um, at the same time, you have growing government debt because of this issue, because of the subsidized energy costs. So even though Bangladesh has been a high grower, and has been very successful in taking market share from China, for instance, they have a lot of debt at the government level. So you can sort of see the dysfunction in some of these strategies. And now one of the big question marks is, how sustainable is this? And we talked obviously in recent weeks about Egypt and sort of a whole host of countries, Nigeria, Ethiopia, that are facing similar issues. Um, Bangladesh has a lot of those issues, especially with regard to government debt and currency problems, things like that. Now they have political instability that's rising, and their sort of one trick pony is potentially at risk, because without the subsidies, Bangladesh, other than super cheap labor, they don't have much else going for them. Um, so this is more important than people think, and I think one of the broader implications to think about in regard to supply chains and automation and stuff is the two kind of most attractive places in the world to do textiles right now, the industry share gainers, are Bangladesh and Nicaragua, which are both, for lack of a better term, shithole countries with a real authoritarian uh, uh, government in charge. And, is that required to be competitive on the global level? Is that what we have to rely on? And is that stable in this new environment that we've been talking about, where countries that face these issues are finding it difficult to retain control? Um, and you could speak specifically within textiles, like I brought up, just to educate myself, I was looking at the different facilities of Gildan Activewear, which is one of the biggest textile producers in the world, very well-run company, globally diversified. Their two biggest exposures are Nicaragua and Bangladesh, of course, but those are for the sewing facilities, where there's a lot more of a labor component. You're literally sewing with a sewing machine. It's very people-oriented. But then
Mm.
they have their yarn spinning facilities, which are almost entirely run by robots, and those are all in North Carolina. So it's an interesting story here about, the bottom of the barrel sort of labor cost arbitrage. And speaking of, vulnerabilities and volatility, when does that break? And maybe you're getting a break here.
Yeah, I mean, I think you can see that in that, despite the fact that the situation in Bangladesh has not stabilized, I would say at all, garment factories are back open, and you've got leaders of different associations, whether it's the Bangladesh garment association or things like that, coming out and saying, okay, we lost 4 days, we're assessing the damage uh, to reputation, but there's no physical damage to the factories. We're ready to go. We're completely normalized. I saw one report from a company that's based in India that outsources a lot of its production to Bangladesh, that said they're moving all of their production for the rest of the year to India to mitigate risks. So that's the kind of thing that should probably scare Bangladesh very, very quickly. And I don't know if you saw I don't know if this is still current, but the top apparel exporting countries in 2022. So this might have changed in 23. I mean, China's still at the top there, but Bangladesh number two. The next three were Vietnam, Turkey, and India. So I believe that Nicaragua is growing fast, but there's probably a limit to how big that market can become. And I mean, Vietnam also not exactly a poster child for stability. So China, you've got Uyghurs and geopolitics and everything else. Now you've got Bangladesh and Vietnam flashing red, and then it's Turkey and India, or sort of your choices there afterwards. So I mean, kind of a significant market where all of the different key cogs in the supply chain are flashing red a little bit.
Yeah, for sure. Um, and China, I think, has been losing share, or even, I don't know if this is the case, if they're actually reducing capacity, but the labor cost differential is so wide now between even the inland areas of China and a place like Bangladesh or the poorer regions of India, that you're talking about a 20 to 25% uh, labor cost difference. which is just not sustainable in this very, very, very tight margin kind of industry. So it's interesting how quickly you either automate or you just get out.
Hmm. It's also I can't think of a. It makes sense to me that Nicaragua has bet big on textiles, and I can think of several countries whose exports are focused on one sector, like Taiwan, for example. It's basically semis and tech associated with semis. So that's a higher level of sophistication, but it's still you're basically a one trick pony. The difference with Bangladesh and some of those other countries is we're talking about a country of 180 million people. We're talking about one of the most densely populated countries in the world. I can't think of a country at that size that has bet so much on a single industry. Can you think of any?
Um, I can't, but I think it's really interesting to look at this example because, as we've talked about many times, there's only a small handful of miracle examples in the world of countries that have gone from truly poor to middle income or above. And most of them are in Asia. I mean, all of them are in Asia, really. Um, and usually textiles represents sort of the very, very bottom foothold of what you do. So Japan, for example, post World War II, they they grew their textile capacity a lot and they sold into American markets. Actually, a lot of sort of Japanese streetwear and fashion and all of that sort of very high end part of the world now is rooted in sort of much more humble Japanese textile firms that grew up in post World War II and were able to compete and sell into an American market that was very receptive to them and was at the same time shedding its own textile capacity. So textiles are traditionally sort of the foothold that get you up the ladder. And obviously Bangladesh has gone down that route, but they don't have any of the other sort of elements to replicate that miracle. So Japan started with textiles, but immediately, essentially redirected the capital and the foreign currency earnings that it made from that into thoughtful investment to grow the other areas of the economy. And not only to grow them, but to make them globally competitive and to learn how to do things, how to compete in export markets. I mean, a very specific formula for keeping firms disciplined. Bangladesh doesn't have any of that. Bangladesh is sort of like the worst aspects of India from an infrastructure and a corruption standpoint without any of the positive elements that you get in India, with the exception of this one sort of cosseted industry. So it's a really unique and interesting example. And it's also funny that Mohammed Yunus is becoming the interim prime minister. I don't know if you know about him, but he was like 20 years ago, he was lauded as the microcredit guru. And at this time, microcredit was sort of the neoliberal wet dream for how you're going to use free, financial markets and financial innovation to make poor people wealthy. And the whole thing was really stupid, frankly, the idea, and it totally fell apart and blew up. And he was the guy in Bangladesh that was sort of one of the pioneers of designing these systems, and um, it did not really produce the outcomes that many people hoped for. So now he's the guy in charge.
Nominally, at least. I mean, and this is the before we leave Bangladesh. I mean, the other interesting thing happening here is that Bangladesh is a Muslim majority country, but the Hasina government has had very good ties with India, and some of the violence that has been happening in the last couple of days, it's gone beyond just clashes between student protesters and the security forces. You've now had violence directed at Hindus, because it was seen like the Hindus were supporting the Hasina government, and Hasina is in India, and maybe India is still trying to figure out how it can preserve some level of geopolitical influence here, even if at sort of a religious level. And I mean, this goes back into history that is really complex, and we'll have to get somebody to come back and talk about India's partition and India, Pakistan, and Bangladesh breaking off. I mean, there's a whole sort of like we'd have to do an entire series on that just to get to the real complexity of that. But there is some geopolitical intrigue there as well, and it'll be interesting to see which way Eunice goes and whether the country can calm that down. Because the most disturbing thing here is that you do have some great power interest around this, and you do have some ethnic and religious divisions that it looks like are starting to get grafted onto these issues of poverty and debt and things like that. So something to watch there in general. Why don't we to round out the podcast, let's leave the bottom of the sophistication food chain and rise to the top of the sophistication food chain. I don't understand all of this, but I understand enough to know that it could be very important. So there's a professor at the Okinawa Institute of Science and Technology who claims that he has designed a new type of extreme ultraviolet lithography equipment that could reduce the cost to produce semiconductors. Um, you said, Rob, that probably a lot of our listeners are not trading every day. I bet even fewer of them are keeping up abreast of developments in EUV equipment or even know what EUV equipment is. But these are the machines that you need to actually make the high-end semiconductors that everybody's talking about, which Taiwan makes and all these other sorts of things. And I mean, if it's real, what's going on here, it apparently reduces the energy consumption that a lot of these machines need. I mean, by an astronomical margin. I had the figure in front of me and I can't find it. Hold on, let me find it. So his new method, which reduces the number of mirrors that are used in the equipment itself, it basically allows you to do what you need to do with EUV equipment with 1/10 of the power. And so he's filing for a patent already. There's plans to work with another Japanese company to try and demonstrate on a half-scale model. So they'll take something that's already existing and they'll try and apply this and see if they can get the gains that this guy has published, this professor. And then if all goes well, I don't know, are we looking at the end of ASML's dominance? I don't know. I know that you looked at this a little more closely, but this seemed like a very big deal, at least to me.
It is a very big deal. Um, what are the investment implications? Obviously, you could speak about ASML specifically, but I think this is a nice opportunity to talk about technology and investing and having a long-term horizon and what we look for, at least. I mean, others may disagree, but a big part of what we do for clients, one of the key things is really trying to identify companies that are harnessing, kind of these key technology tailwinds and are going to do so for a decade plus, which sounds glib, but is actually an extremely difficult exercise once you really think about it. Because what makes a company durable over a decade? And the reason why I bring that up is we've spoken in the past about ASML, and it's sort of funny that this emerges because Canon came out with a um, not really EUV type technology, but something similar 6 or 8 months ago, and we spoke about it at that time. But what we said then, and what we'll repeat today, is um, durability is sort of a reverse pyramid in some ways. And what I mean by that is just think of semiconductors. Lithography is the most important part of making a semiconductor. And lithography is essentially putting a mask over the wafer and shooting light at it to etch the circuits into your chip. And that's an extremely difficult and delicate process. I mean, I can't even put it into words how difficult it is to do that at the level required for these high-end chips. So the bulk of the value add on the equipment side is in this lithography equipment. And everyone knows, oh, one of these ASML machines costs $300 million. I mean, it's ridiculous. But the problem for ASML is they've created this wonderfully complicated solution to a very difficult problem. And I mean, if you really get into the technology, which is difficult to describe verbally, but it's essentially imagine like a giant Rube Goldberg machine. Um, I mean, you literally, it's a giant laser firing a photon beam at falling aluminum molecules, and it causes the molecule to fly off and hit a series of 6 mirrors, and then that hits another thing that goes into the wafer. And I mean, it's hard to overstate how complicated every step is and how sort of special. Um, the problem for ASML is, like, at that part of the semiconductor supply chain, the equipment supply chain, everyone is gunning for you. And if you were to look at ASML, ASML was a company no one had heard of 15 years ago.
Mm-hmm.
These guys didn't even exist. The leaders in the prior generation of lithography equipment were the Japanese companies. Like Canon was one of the big players, for example. And the reason is because the prior generation of technology was focused on using lenses, not mirrors. And Canon, the camera company, they're really good at lenses. That's what they do. So they were the top dogs in the late 1990s and into the early 2000s. And then ASML came and created a new and better way, and they captured, the peak of the pyramid. So the problem is that, as I mentioned, everyone is gunning for you, and there's a lot of technology innovation happening to try to sort of capture that peak of the pyramid. And if you look at something like ASML, like obviously less so in recent weeks, but the way everyone talks about this company, the way everyone assumes it's set up competitively, pays no attention to history, because everyone who waxes, eloquent about, and it's been all over the media in the recent years with the semiconductor boom, oh, it's so complicated. And they have the supply chain. There's hundreds of German companies that just line up to provide this one little lens for the thing, and then they fire this giant laser, and no one could ever do that. And like everyone talking about how impossible to replicate it would be. And yeah, but the risk is that you end up like Canon, where like, oh, we're not going to use lenses anymore. Or like someone is developing some innovative technology to capture that value add. And that's been the risk for these guys. And that risk is not reflected in the assumptions or the price of this stock. And for that reason, as I said, 10 months ago or whatever, when we were talking about this last, we wouldn't touch ASML with a 10-foot pole for our clients. This is
Mm-hmm.
not a good investment. This is a bad underwriting decision to buy that, at 20 times revenues or whatever it is, that it's been trading at recently. So, anyway, what I'm trying to talk about is durability. If you were to compare ASML to like an Applied Materials or some player that is in a different part of the supply chain where it's more oligopolistic, it's more stable, it's less sexy, um, those tend to be more durable investments over that time horizon. So anyway, I won't draw on and on, but my point is, if you're looking to really be a technology investor that's looking beyond, the next quarter or the next year and operating on those time horizons that matter for the clients that we work with, you really have to think about these things and be sure that you're underwriting durable competitive advantages that truly are not subject to unknown things emerging because there's some innovative Japanese professor that all of a sudden is going to, come up with something that drastically could change the technology that's used.
Well, and to your point, the real trick is finding what is the ASML of 15 years from now. What is the one that people are going to look back, 15 years in the future and say, well, if you had just bought this, which was so obvious at the time, it would have worked. Um, which ASML is one of those. It can also be legacy names. I mean, I'm old enough to remember a time when Microsoft was in the doghouse. Like, you wouldn't touch Microsoft with a 10-foot pole. Right around 2010, 2011, they'd come off the dot-com bubble. It was the stock that was left for dead. Nobody wanted it. And now, like, look at where Microsoft is based on how they've been able to change things. Well, so one thing I want to ask there, then, you've already brought up Canon, and it's Canon and Nikon are the two names here where they're the most recent generation before ASML displaced them, where they were the ones making the equipment. They seem to be the ones closest positioned to actually make a big bet on some kind of change in this technology and actually having the expertise to carry it forward. They're also already selling old generations of their equipment into China because China's desperate for any kind of lithography equipment at all because of all the restrictions on the cutting edge things. Is it as simple as, hey, like, might be time to look at like big businesses like Canon and Nikon again, or do you think that the answer here is, like, that's sort of the past? What this professor is showing us is that major change is coming to this industry, and maybe we don't even know what the change is going to be yet, but probably the giants of today or even 5 or 10 years ago are not the place to look, and we should look at where these changes are going. Does that question make sense?
Yeah, I don't really have a view on Canon and Nikon. Um, I don't think any of them are particularly interesting. I think it's an area that is really well combed over, and there's so much enthusiasm, or it's starting to wane now, but there has been so much enthusiasm that semiconductors are an area where we're just really have almost no exposure right now in terms of sizing and underwriting those risks. So yeah, I mean maybe they could break in and take market share away, with new technologies that they develop, to compete with ASML directly. I I would just be speculating on that. But I think y- you're not getting paid for the risks to own any of these things for the most part.
Hmm.
Um, and no one really knows. I mean, they probably can't in the near term. It could be some player we don't even know about, some guy in a garage right now making something
In
um,
Bangladesh.
in
He
Bangladesh.
lost his garment job, and he's figured out how to get the mirrors
Yeah.
completely right, and he's going to absolutely change the world. Before we leave, because this is tangentially related, but I actually haven't gotten a chance to ask you this on the podcast or not on the podcast. So I know one name we've flirted with it for a while. I don't think we've got it open right now. Is Intel. And as Chase, a friend of the podcast over at Pinecone Macro, said to me in an email, worst earnings of all time last week from Intel. There's a stock where you literally are no longer being compensated for the risk because they eliminated their dividend and things look particularly grim. Um, do you have any thoughts about Intel? I mean, sort of a giant that has been overtaken, and now is it in a death spiral? Is it just like sentiment is really bad, and maybe they could come back? I'm just wondering if that, or if there's any lessons to learn from Intel, because it is part of this conversation too.
Um, I think the whole area is very difficult. Um, we don't own Intel for our clients, and it's not something that I'm jumping up and down to go dig into right now and spend the time to analyze. In part because, as I said, the whole sector has been just so overloved that this is the question that so many people are asking. Like Intel is in everyone's crosshairs. Oh, this is the cheap one, right?
Hmm.
Um, they have serious problems. Maybe they will overcome those problems. I don't know. Are you being paid? What sort of risks are you underwriting? Are you getting paid for, a range of outcomes that's broadly good? You know, maybe, but it's not a screaming buy. And I think the key questions are in some ways about geopolitical issues that you've gotten into with regard to the CHIPS Act and whether Intel can truly become a national champion and whether that will even be a thing
Hmm.
in the future and in the US. Is this actually going to happen? This capacity build, is it going to be real? There's a lot of unknowns, both geopolitically and just company specific and competitively and strategic to Intel in particular. Um, it's as my friend Britt would say, it's a pair of twos. You know, it's not anything to be excited about. It's not a long. It's probably not a short. It's just a meh.
Fair enough. Well, I think that's good. We started with market insanity. We did Bangladesh, and then we came back around to semis, which I mean, semis might be driving a lot of the market insanity when you get down to it. All that love is expressing itself in overconfidence and in inflated valuation. So maybe there's something there. Anything else you want to say to the listeners before we get out of here, Rob? How was Paris during the Olympics? You don't seem to have gone crazy.
No, it's been wonderful. Uh, Everyone was expecting things to be terrible. like hot and crowded and, just poorly run. It's been the opposite of that. It's been really nice weather. It's been wonderfully well organized. We went on Monday, we saw the pole vaulter. Did you see this story?
I think I know what you're talking about.
I mean, this is shocking to me because this was such an incredible sports story. I think the Wall Street Journal had one little thing about it, but there's nothing on ESPN, nothing on New York Times, none of the main media picked
Maybe
up
I
on
didn't.
this.
What is it?
This guy, he's from Louisiana. He plays for Sweden because his mother is Sweden,
Hmm.
and he absolutely blew away the Olympic record. Like it is what an incredible sports story. Like anyone who has a feel for numbers can understand how extraordinary this is because we were watching the final. We went to the Stade de France, and we're watching the final, and they start at 5 meters point seven,
Mm-hmm.
right? So 5.7 meters. That was like where everyone started, and then like the top guys in the final started failing and dropping out at like 5.85, 5.9. One guy, the second place guy, got 5.95, and then he celebrated like it was
Yeah.
extraordinary. The American guy, which it was, right? So the previous Olympic record was 6.03, right? This guy comes in and he beats everyone like easily. First of all, his name is he has a French name which I'm totally blanking on right now. I'm sure you'll find it while I'm talking.
Pierre something.
Uh, so he beats everyone in the competition, and then he says, well, I'm going to try to beat the Olympic record. So they put it up to 6.1, and he does that on the first try. And then he said, and then he, because of the way the rules work, he can go, like he's the only one remaining, but he has another round. So
Mm-hmm.
he says, well, I'm going to try to beat my personal record, not the Olympic record, which was 6.25. They started at 5.7 and everyone failed at 5.85, 5.9. He did 6.25,
Wow.
and he did 3 tries at 6.25. And on the third try, this was like, you couldn't have written a movie better than this. He failed the first try, he failed the second try, and each time there's like a 10-minute wait. So he's like gathering his energy and everyone's singing and doing the wave and stuff. And on the third try, he gets 6.25, and he blows away the Olympic record, beats his own personal record, which is like one standard deviation away from anyone else ever. And he's a hero. And no one in the US knows who this guy is or talked about it at all. I looked on the thing, it was
No.
like Simone Biles farted yesterday. It's like, come on. This is an incredible story.
Man, drive-by shot at Simone. She didn't do anything to
No,
deserve
I
that.
love Simone Biles, but it was like the umpteenth story about some unimportant aspect of her performance,
Yeah, yeah, yeah. So his name, I can't believe I haven't heard of him in local Louisiana press. Armand Duplantis. I guess his nickname is Mondo. He's 24 years old. He looks like a little baby. He was born in Lafayette, Louisiana, and went to Louisiana State University, LSU. Go Tigers! Um, wow. Well, I'll see if I can. I wonder if he's still hanging out in Baton Rouge. Maybe I'll see if I can hang out with him and get his advice on what poles he uses, so we can invest in poles for pole jumping. Um, well, good. That's great. I'm glad I
Yeah.
asked. Well, I'll let you get back to finding these diamonds in the rough, Rob, and we'll talk to you next week. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.